Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another session. Plenty of interesting things to talk about this week with new all-time highs in stocks, new all-time high for gold, a lot of interesting things going on in the other commodities, and a couple of stocks I want to talk to you about later on as well. Of course, as well as any ticker codes you'd like me to go through. Get them ready. We'll go through those at the end of the show. Now, of course, everything today is general commentary only. Doesn't take your personal situation into account. Having been through all that, let's get into our first chart. So starting with the ASX 200, and we have a new all-time high just yesterday, and then following through early this morning. The question now is whether we're going to see a series of all-time highs, or is this the last push higher before we get some type of a larger pullback? I've got some charts to go through to help answer that question. I think that's going to be pretty interesting. And what's particularly interesting, I think, is what's happening in the small ordinaries and also in the emerging companies index. I'm going to take you through those a little bit later. But first, just looking at what we have here in the ASX 200. So the latest all-time high comes after a short period of consolidation just below the previous peak from late January. And that's been the pattern since the December low. So if we go back to the December low, it's been a process of strong rallies with these short but sharp pullbacks. And there have been three notable pullbacks since December. The first being on a strong US employment report, which is around here, where there's a prospect of slower interest rate cuts. Then, of course, we had the Chinese AI developments, and then just most recently, it's been talk around tariffs. So these have been the three things which have prompted some nervousness and some selling. But none of these developments have attracted further selling. None of them really attracted that follow-through selling to send the market lower. It's really been a case of we've had these quick sell-offs, which has kind of been like sell the headline. We've had these sell the headline moves, and then those reactions have been followed by a strong buy the dip response, which on each occasion has sent the market higher. And I think that tells us a lot about the underlying state of the market. So we've had attempts to take prices lower quickly, where prices are quickly falling, and then the bullish forces come through and push prices high. So that tells us that the bulls really do remain in control of this market at this point in time. And this is something we often experience in bull markets, and that is there are often reasons to worry. And we've just seen three of those reasons in the last month. Slowness on rate cuts potentially, AI, tariffs. Yeah, there's always something to worry about. And for many people, when a market quickly pulls back from an all-time high, it often feels for a lot of people that this is just the start of something bigger. And well, look, all-time highs, it must be risky, and hence a lot of nervousness. But I think while the trend remains in place, while the overall upward trend remains in place, I'm working on the basis that the path of least resistance continues to be to the upside. And this is something we've been talking about really for months now, over the last year. The benefit of the doubt goes to the incumbent trend. And the incumbent trend since back in late 2023 has been to the upside. The key structure on this chart remains these moving averages. I've got the 50-day, I've got the 100-day moving averages. And this has been the case for the past year. The ASX 200 has been above these moving averages for most of the time. It had a couple of brief excursions below, but for the most part, ASX 200 has been above the rising moving averages. And that's, of course, where it currently is now. So this is the structure that is associated with bullish markets. Now, This does not mean that we should ignore risk. It doesn't mean we should go all in on the bullish theme because we're breaking the new highs. Even in a bull market, we've always still got to take risk seriously. It always needs to be taken seriously. Nothing's ever certain. At some point, an all-time high, it does lead to a lengthy decline. But of course, no one knows where that final high is going to be. Lots of people are going to tell you they know, or they think they know, but the truth of the matter is nobody actually knows where the high is going to be. So I think rather than trying to pick a top, I think the best play in this situation is to go with what's working, and what's working has been the rising trend. I think backing the trend is generally more profitable than betting against it. And I can tell you that from hard-won experience. There was a time earlier in my career where I was all about trying to look for patterns at predicted tops, but most of the time the market would run over the top and it becomes expensive. The money's made by staying with trends, not betting against them. Regarding risk, I think it's a case of making sure the stock selections that you look at have the right setups. So for me, the right setups is when you have a stock which is crossing above rising moving averages, or already above rising moving averages and breaking out. And then making sure there's a good risk return profile. So we don't want to risk more than we think we could make. We want to be able to make a multiple of what we're risking. It's got to have that good risk reward profile. And we can then use strategies like the trailing stops, letting profits run, and then those trailing stops can provide us with that exit plan for when prices do invariably turn down at some point along the line. Now, I want to go over, have a quick look at the equal weight, the ASX 200 on an equal weight basis, because that's always interesting to see what it's like, what's the index like when you take out the influence of those larger companies. And what we have just today, where we had a new all-time high in the equal weight earlier on Friday, with prices clearing the December and October highs and also getting above this peak from back in January 2022. That was the previous all-time high. As we go to where now, we've just ducked back down beneath that previous high, but nonetheless, a new all-time high has been made. And this breakout follows 2 weeks of consolidation below the January high. I thought we might have seen maybe a bit more consolidation beneath the highs before a potential breakout. But I think the big clue that the breakout was coming, and this is what we spoke about last week, was that the market was doing a really good job at holding on to these strong gains off the January low. When a market can hold on to its gains, it's a sign that buyers are stepping up to buy and support on pullbacks. I think the big thing to remember here is that all-time highs tends to lead to more all-time highs. Now, people often worry that an all-time high means a top must be near, but that's actually not supported by the data. The odds favour all-time highs leading to higher levels. That's what makes a trend. Higher prices lead to higher prices. Of course, there's an endpoint, but if you want to go what the odds favour an all-time high will precede another all-time high. I think this is an environment to be long stocks, be actively looking for opportunities. I'm looking for stocks with either emerging momentum or established momentum. So it could be a case where momentum is emerging, just prices coming up above moving averages, or as I said earlier on, it's about maybe breakouts from established upward momentum. That's where I think the opportunities lie. And that's what I'm doing with the Motion Trader service. It does that. It does those scans. It looks for the momentum. It looks for the breakouts. It finds the opportunities. And this is where I believe the odds favour the best gains and where you can get the best gains with potentially getting the least risk, which is always an important thing. Now, if you're getting some value, please hit that like button. Leave a short comment. Just, hey, thanks for the video. Just tells YouTube you're watching. YouTube shows other people. That helps me heaps. Please do those things. Like and comment. That'd be fantastic. Now, let's go to the US. Let's check out what's going on in the US markets. And we'll start with the S&P 500. And yet again, the S&P 500 has seen off another potentially bearish catalyst on Wednesday. And this was when a higher than expected CPI or inflation report came out. We had this brief market sell-off before the market rebounding. So that's now 4 potential bearish developments that have been pushed to the side. So we had this false break back in mid-January, and as we were talking about earlier with the ASX, that's when there was a strong employment report, concerns interest rates wouldn't be cut so quickly. The AI, the Chinese AI, and the tariffs, and now we've got the CPI. So we've had 4 potentially bearish developments that hasn't been able to send the market lower, and I think it's a sign that when you get a market that's resilient to potentially bearish news, it's a sign that the sensitivity is typically in the opposite direction, and that prices are likely poised to rise, not fall. Just looking at this latest price action, the S&P 500, it's been coiling up in this tight range, just over over the last 3 to 4 weeks, and this follows a strong rally off the January low. So we've got a strong rally followed by a tight consolidation over the last few weeks, and there are a couple of important points to make about this. So, firstly, the S&P 500 has been holding on to most of the gains. So the rally off the January low, now the S&P's been holding on to most of those gains over the last 3 or 4 weeks. Now, that's an important thing to see, because it's when you get these modest pullbacks after strong rallies, I think it's especially telling, because it's telling you that there's support on the pullback, and especially when we're getting those headlines which could otherwise send the market lower. To find a modest pullback under these conditions, I think it's a positive situation. And what the modest pullback suggests, it suggests that the buyers are stepping up to accumulate on the dips. So that's a bullish sign. The other important point is that these compression patterns, especially when we see coiling, when we see the price action start to coil up along rising moving averages, so these moving averages, the 50 and the 100-day moving averages, when you get this coiling along rising moving averages, more often than not, the result is higher levels. Well, that's at least in my experience anyway. Just on the moving averages, this remains a key consideration for me. It's these moving averages continue to rise. Again, the 50 and the 100-day moving averages, they've been in a rising period for over a year now, and that remains the case. And whilst price remains above rising moving averages, well, we have a bullish structure. Want to quickly have a look at the NASDAQ. Prices are just starting to break out from Thursday, and we can just put a line across here to demonstrate that. So just picking up the high from December, the high from January, another high from earlier in February. So we've got like this downward trend line, and it's bounded by the lower level. We can't draw such a neat line, but essentially there's support that comes in, around the bottom. So you can see, again, it's one of those coiling generally a coiling structure, and prices are now starting to break to the top side. And we talked about this last week, that we had this coiling pattern into the rising moving averages. Now we have the breakout. Prices are also rallying off the moving averages after this, and this is a 2-month consolidation. You can see prices coming back just below the 50, above the 100-day moving averages. Now we're starting to get this lift off the moving averages. These pauses, typically, when you get a consolidation and a pause in a rising trend, the trading range typically results in quite a bit of pent up energy. It's a bit like a coiling spring. It's like you're compressing a spring, and then once it breaks out or the spring is released, you tend to get that movement in the direction of the break. So in this case, it's a break to the top side. So I think the odds favour we're about to see a series of new all-time highs in the NASDAQ. One other thing I want to show you on the US market, which is interesting. This is something I think which is always worth keeping an eye on. This is the percentage of S&P 500 stocks above their 100-day moving average. What we have here is in the first half of January, we saw a strong rise in this indicator off quite low levels. It wasn't, when we just compress this a bit, get a bit more data, it wasn't exactly washout levels like we saw during 2023, 2022, after COVID. Didn't get down to washout levels, but nonetheless, it is like at the very much at the lower end of the band. So from that lower end, we've got the strong rally, and then in the last few weeks, we've had this generally been quite stable, been stabilized around about the 50% mark. So currently 52% of stocks are above their 100-day moving average. And I think when we see strengthening indicator followed by stability, particularly in the case of this indicator, I think what this does, I think this sets this indicator up for a push towards the upper end of the range. And if more stocks are above their 100-day moving average, then the market's rally that we're starting to see come back into play now, the market's rally becomes more broad-based, so more stocks are participating. In a healthy market, in a healthy rally, you want to see a lot of stocks participating, not just Nvidia and Microsoft and some of the big ones. You want to see a large participation, and if we get that, I think that's supportive of higher prices generally. As always, though, it's never a time for complacency. It's never a time for throwing caution to the wind. But despite reasons to worry, as we've discussed earlier, and there typically are. There's typically heaps of reasons people can find to worry. At this point, this remains a bullish market. This is a market which is trending higher. I think the play remains being long stocks, actively looking for opportunities, and using calculated position sizing and wide trailing stops to see off the consolidations and to manage risk. Really important, manage risk. I always want to know where the exits are for when conditions do ultimately change. So it's not just going blindly upside. It's like, keep in mind at some point the trend does end, know where your exits are. Okay, so I'm going to jump over to the US small caps in a moment. I've got the local small caps, the commodities. I've got a couple of stocks I want to show you, but of course that wraps up the free section. If you're not a strategy session member, there's a link below. Click that, come on board, costs very little, and I think you're going to get a whole heap of value for the really the small amount, a cup of coffee type of money that you pay to come along. So okay, let's kick off. Let's kick off with the Russell.